Hi and welcome to this video. In this video we'll be talking about how do you select a mutual fund? How do you decide whether the mutual fund should be a part of your portfolio or not? So let's dive in. Now when you're selecting a mutual fund, there are a few things that you need to look at. You should be looking at the fund's objective. You should be looking at the expense ratio, the fund manager's track record, and the fund's performance. Now let's start with the fund's objective. Now every fund would have an objective, and that objective is mentioned on that fund's website. Now that fund's objective should match with your investment objective because it is important. Let's say if you want to invest in the large cap fund because they provide stability and a better returns than a short-term fund, then you should be looking at the fund which only is investing into this large cap universe. Because if there's a mismatch, and if you invest in a fund which is investing into large and mid cap, then, and in case if the market does not do well and the mid cap crash, then the fund performance would go down, and you would realize later that this fund was had a different objective. It was also investing into mid cap, which is more volatile than a large cap, right? So let's look at some of the fund's objective and how do you zero down on the fund that matches your objective, right? So let's start with the ICICI Blue Chip. Let's start with ICICI Blue Chip. Now if your objective is to invest into large cap funds, then this could be the fund that you should be investing in. So let's look at the investment objective that this fund has. So the investment objective of ICICI Prudential, okay, this is US Blue Chip. Let's read this. US Blue Chip Equity Fund is to provide long-term capital appreciation to investors by primarily investing in equity and equity-related securities of company listed on recognized stock exchange in USA. The scheme shall also invest in ADR, GDR issued by Indian and foreign companies. Now, if your objective is to invest in US companies, good US companies, and you want to do it through India, then this is that fund for you, right? So by going through the objective, you'll be able to find out whether the fund matches your investment objective or not. Now, let's check out the Blue Chip Fund. ICICI Prudential Blue Chip Fund, and let's find out the objective of this fund and if it matches with our objective. Now if our objective is to invest into large cap funds, then does it match it? The scheme seek to generate long-term capital appreciation and income distribution to investors from a portfolio that is predominantly invested in equity and equity related securities of a large cap companies, right? So it matches with our objective. Now you may say that the name clearly states that, right? It's a blue chip fund, so it's investing into large cap funds, but that's not always the case. Let's look at this fund. The objective, it says Mirai Asset Large Cap Fund. So again, the name suggested, but it's always advisable to check the objective. So long-term capital appreciation by finding investment opportunities relating with it. Now this investment objective does not categorically mention that this is actually a large cap fund, and there's a reason for it. This fund actually was into mid cap, large and mid cap. It has recently moved from mid to only focusing on large cap, but the objective has not changed as yet. It's not clearly mentioned in the objective as of now. Now sometimes, although the name actually has changed, so large cap here suggests that they would be investing in large cap only. Now sometimes what happens is, if you look at some other fund, let's say if we look at this one, Idbi Focused 30 Equity Fund. Now focused 30 would suggest that they would be investing into a portfolio of 30 stocks, but now would that 30 stocks be belonging to small cap, mid cap, large cap? Will it be a multi cap? This does not get specified here. Now here, if you check the objective of the fund, you'll get to know what exactly is that fund looking to do. So here the objective says the scheme aims to generate capital appreciation by investing in a concentrated portfolio of a large cap focused equity and equity rate. So here it clearly states that it is looking to invest in a portfolio of large cap funds or large cap companies and securities up to 30 companies. So it's going to be very focused fund. They are not investing into 50-60 companies. It's going to be very focused fund, and it will be only and only large cap. Now if you want to invest into large cap only, then this is that fund for you, right? Similarly, even for a short-term bond fund, you would have the same. Let's look at the Kotak saving, for example. Now let's say we did discuss that interest rate going up and down would impact a fund, especially a debt fund. Now what happens is, let's say you do not want that interest rate to actually impact you that much. Then again, if you look at the objective, it would give you some bit of clarity, right? So this is a debt fund, a Kotak saving regular debt fund, and the objective here is the scheme seek to generate returns through investment in debt and money market instruments with a view to reduce the interest rate risk. Now when you're investing in a debt fund and you do not want that volatility that may come with the interest rate going up and down, then this could be that fund, because what they would be doing is they would be investing into companies which are which have a shorter maturity, and the interest rate would not really impact much. Interest rate going up or down, that would not really impact. Remember the example that we took. So if you stay invested and even if the interest rate go up and down, by the end of that period, let's say if that period was 10 years, after the end of 10 years, what would happen is you would have earned your interest all these years, and you would get your capital back, right? So it doesn't really impact. So as a security reaches its maturity or is close to its maturity, the interest rate going up and down does not really matter, right? So this fund, what it actually tries to do is, if I have to show you this, so if you just scroll down and you go to the snapshot and you check some numbers here. If you look at the portfolio, I won't be really going into details. I want to keep it as simple as possible, right? So there's something called modified duration, and there's something called yield to maturity. Now this will tell you that if you invest right now, this is the NAV, 30 rupees. If you invest right now, this is the kind of return that you can expect, right? 7.5, around 7.5. Now, and there's another thing that you should be looking at. This is the modified duration. Now if this number is a high number, then interest rate change actually would impact the fund that much more. So here it is almost next to zero. It's almost 0.5%. So what it means is, let's say if tomorrow RBI increases the interest rate by 0.5%, this fund would be impacted by just 0.25%. It won't be much. The impact won't be much because they are trying to invest into those securities which are closer to the maturity, and the interest rate change here would not really impact much because there's very little time for maturity. So when you're looking for something which gives you stability, and you do not want too much volatility even in the debt fund, then the modified duration should be smaller. Now let me show you something which is long term. Let's say HDFC Gilt. Now here if you go back and check modified duration, this is 3.34%. So let's say if the interest rate goes up by 0.5%, in this portfolio or in this mutual fund, there would be a loss of 1.5%. Of course, that loss would be filled because every month you're getting that interest, and that would be filled. But for that moment, you would see the notional loss, right? Because the modified duration here is 3.34. What modified duration tells you is, it tells you the sensitivity of the fund with respect to the interest rate change. Now it can work in your favor as well. Now let's say if there is a 1% drop in the interest rate, this fund would actually give you 3.34% more return because the interest rate has gone down. So basically, modified duration into the interest rate change would tell you how much it would impact your portfolio. Now, in case if the interest rate has gone down, then this would benefit you, and if the interest rate has gone up, it will actually impact in a negative way, right? So what modified duration actually tells you is that it tells you the sensitivity of the fund, the bond fund that you've chosen, with respect to the interest rate change, right? So this is what you can actually look at, and even if you don't want to go into details, if you're simply checking the portfolio's objective or the fund's objective, and if it matches with your fund's objective, that's more than enough. That's all you need to know. So let's go into the next video where we would be covering the expense ratio, which is a very important aspect. So we'll cover that in the next video.